On April 2, 2025, the world watched with bated breath. The anticipation was palpable, as millions of eyes were glued to screens, waiting for the announcement that would soon shake the global economic landscape. As President Trump stepped up to the podium, the air was thick with tension. He dropped a bombshell that no one saw coming. He announced sweeping tariffs targeting over 90 countries, a move that would send shockwaves through international trade. This was a bold move, a declaration of economic warfare on a global scale. The tariffs were not just a minor adjustment, they were a seismic shift in the way the United States would engage with the world. The reaction was immediate and dramatic. Financial markets, always sensitive to geopolitical changes, responded with a sharp downturn. Stock markets around the world plunged, signaling a wave of fear and uncertainty. Investors scrambled to make sense of the new economic reality. The tariffs, a cornerstone of Trump's economic policy, were back with a vengeance. This time, they were not just a tool for negotiation, but a statement of intent. This time, they were bigger and bolder than ever before. The scale and scope of these tariffs were unprecedented, affecting a vast array of industries and sectors. The president promised to bring back jobs, reduce the trade deficit, and restore America's manufacturing dominance. But at what cost? The question lingered in the minds of many. The world held its breath. The implications of this move were far-reaching, affecting not just the United States but economies around the globe. This was not just about trade anymore, it was about global stability and the future of the world economy. The stakes had never been higher, the stage was set for a trade war, the likes of which the world had never seen. The coming months would reveal the true impact of Trump's bold move, as nations braced for a new era of economic conflict. The devil, as they say, is in the details. When it comes to international trade and tariffs, this saying couldn't be more accurate. The intricacies of tariff plans can have far-reaching consequences, affecting not just the countries involved, but also the global economy. Understanding these details is crucial for businesses, policymakers, and consumers alike. And the details of Trump's tariff plan were complex and far-reaching. The plan aimed to address trade imbalances and protect domestic industries, but it also introduced a new layer of complexity to international trade. The tariffs were designed to target specific goods and industries, making it essential for businesses to stay informed and adapt quickly. Initial reports suggested a 125% tariff on Chinese goods. This figure alone was enough to cause concern among importers and exporters. However, the reality was even more daunting. The actual rate was higher, reflecting the administration's aggressive stance on trade with China. However, the actual rate was even higher, at least 145%, due to additional fentanyl-related tariffs imposed in February 2025. These additional tariffs were part of a broader strategy to combat the opioid crisis, linking trade policy with public health concerns. The impact of these tariffs was felt across various sectors, from manufacturing to retail. The tariffs were not applied uniformly. Different goods faced different rates, creating a patchwork of regulations that businesses had to navigate. This lack of uniformity added to the complexity, making it challenging for companies to plan their operations and manage costs effectively. There were exemptions, carefully chosen winners and losers in this high-stakes game. Some industries were spared the harshest tariffs, while others bore the brunt of the new regulations. These exemptions were often the result of intense lobbying and negotiations, reflecting the political nature of trade policy. Smartphones, computers, chips, and other electronics were spared the brunt of the tariffs. These exemptions were likely due to the critical role these products play in the modern economy. Protecting the tech industry was seen as essential for maintaining innovation and competitiveness. Goods compliant with the USMCA trade agreement remained tariff-free, while non-compliant goods faced a 25% tariff, except for energy and potash, which were taxed at 10%. The USMCA agreement, which replaced NAFTA, aimed to streamline trade between the US, Canada, and Mexico. However, the new tariffs introduced additional layers of complexity for businesses operating across these borders. On April 5, 2025, a baseline 10% tariff was applied to all affected imports. This baseline tariff was intended to create a level playing field, but it also added to the overall cost of imported goods. Businesses had to factor in these additional costs when pricing their products and planning their budgets. This complex web of tariffs and exemptions created confusion and uncertainty in the global market. Investors and traders had to stay vigilant, constantly monitoring changes in trade policy and their potential impact on the market. The uncertainty also affected consumer confidence, as people worried about rising prices and potential shortages of goods. Businesses were left scrambling to understand the implications for their supply chains and bottom lines. Many companies had to reevaluate their sourcing strategies, looking for alternative suppliers or renegotiating contracts to mitigate the impact of the tariffs. The ripple effects of these changes were felt throughout the economy, highlighting the interconnected nature of global trade. The response from the rest of the world was swift and decisive. China, the primary target of Trump's tariffs, retaliated with its own tariffs on U.S. goods, raising them to 125%. This marked the beginning of a tit-for-tat trade war. Other countries, caught in the crossfire, felt compelled to act. The European Union, Canada, Mexico, and India, among others, announced retaliatory tariffs of their own. The global trading system, carefully constructed over decades, was unraveling at an alarming pace. The economic landscape was shifting rapidly, and the stakes were high for all involved. The tit-for-tat measures led to increased costs for businesses and consumers alike. Companies had to navigate the new tariffs, often passing the costs on to consumers. This resulted in higher prices for everyday goods, from electronics to clothing, affecting households worldwide. Meanwhile, governments scrambled to protect their economies. Subsidies were introduced in some sectors to shield domestic industries from the harsh impacts of the trade war. However, these measures were not enough to prevent the economic slowdown that was beginning to take hold. The global stock markets reacted with volatility, reflecting the uncertainty and fear that gripped investors. Empty shipping docks and abandoned warehouses became a common sight, symbolizing the disruption in global trade routes. The intricate web of international commerce was fraying, and the consequences were being felt far and wide. Despite the escalating tensions, there were glimmers of hope. The EU matched the US's subsequent pause on retaliatory duties, offering a potential off-ramp from the escalating trade war. Diplomatic efforts were ramped up, with leaders engaging in high-stakes negotiations to find a resolution. Thailand reduced tariffs on U.S. corn, providing some relief to American farmers who had been hit hard by the trade war. This move was seen as a positive step towards de-escalation, and a sign that not all countries were willing to continue the cycle of retaliation. India finalized a trade deal framework with the U.S., signaling a willingness to engage in constructive dialogue. This agreement aimed to boost trade between the two nations and mitigate some of the negative impacts of the broader trade conflict. These developments suggested that dialogue and compromise were not entirely off the table. While the road ahead was uncertain, the willingness of some nations to seek peaceful resolutions offered a glimmer of hope in an otherwise tumultuous period. The global community watched closely, hoping for a return to stability and cooperation. The immediate impact of the tariffs was felt most acutely in the financial markets. Stock markets around the world experienced significant volatility. The S&P 500, Dow Jones, and Nasdaq all suffered initial crashes, reflecting the heightened anxiety among investors. However, the markets proved resilient, rebounding in the weeks that followed. The S&P 500, Dow Jones, and Nasdaq even had their best weeks since 2022 or 2023. This volatility, however, underscored the underlying instability in the global economy. Consumers, too, felt the pinch. The tariffs led to higher prices for imported goods, from cars and electronics to food and clothing. Consumer sentiment declined as anxieties about the trade war and its potential impact on the economy grew. The impact of the tariffs varied across different sectors of the economy. Some industries benefited from the protectionist measures, while others suffered significant losses. Tech companies like Apple and Samsung breathed a sigh of relief, as their products were largely exempt from the tariffs. The automotive industry, however, faced significant challenges. Volvo, for instance, considered moving production to the US to avoid the tariffs. The agricultural sector was hit hard, with tariffs on maple syrup and Spanish olive oil hurting producers. Companies like Anker, a popular electronics accessories maker, passed on the increased costs to consumers, leading to higher prices. The tourism industry also experienced a downturn, with European travel to the US declining.